Hey everyone, welcome back. I am absolutely thrilled to have you here for day 4 of our 30-day options trading explainer series. Today is a massive day because by the time we wrap up this explainer, you're going to have your core foundation in options trading completely locked in. If you've been following along, we've really been building this house brick by brick, keeping things super simple, step by step, and focusing only on what you actually need to know as an absolute beginner. Well, today, we finally conquer the other half of the options equation.
Now, before we get bogged down in definitions, let me throw a kind of crazy question your way. What if you could actually make money when the market goes down? Seriously, take a second and really think about that. We are so hardwired to believe that you only make money when prices go up, right? Buy low, sell high, that whole shebang. But what if you're looking at the market and you are absolutely convinced a massive drop is coming? Most beginners think, well, I just gotta sit on the sidelines and wait for the storm to pass. But what if you could actually profit from that drop? Sounds pretty interesting, doesn't it?
Okay, let's dive right into this because that is exactly what a put option does. This is your secret weapon, a financial tool designed specifically to capture value when things are falling. It literally flips the traditional script totally on its head. And honestly, once you really grasp this, it opens up a whole new dimension to how you look at market charts.
So think back to day 3 for a second. We talked all about the call option, right? And the one golden rule we nailed down was that a call option equals the expectation of up. You buy a call when you think the price is going to climb. Well, today we're introducing its perfect mirror image. The put option equals the expectation of down. It's just a pure binary contrast. Call means up, put means down. If you can cement that in your brain right now, you are already way ahead of the game. All right, so what exactly is it? Let's strip away all that intimidating Wall Street jargon. A put option simply gives you the right to sell something at a fixed price. I really want to emphasize those words for a second. The right to sell. It's basically just a contract. You are securing a guaranteed selling price for yourself today, completely regardless of what happens to the actual price of that item tomorrow. And logically, you gotta ask, when would you actually want to lock in a selling price right now? Well, you use it when you firmly believe the price is going to go down. If you think the value of something is about to absolutely crash, securing the right to sell it at today's higher price, that is an incredibly powerful position to be in. Let's step away from the stock market for just a second and look at a real-life analogy to make this crystal clear. Imagine you're eyeing a specific product out there and you've got this gut feeling. No, you know its price is about to fall. So you use a put option to lock in a higher selling price today. You get a contract that says, hey, I get to sell this product for $100 next week. Next week rolls around, and exactly as you predicted, the product's price plummets down to $50 out in the real world. But guess what? You hold a piece of paper giving you the right to sell it for $100. You benefit massively from that drop, all because you've locked in that higher value before the fall. Now, here is the truly brilliant safety mechanism built right into this concept. What happens if your prediction is just flat out wrong? What if the price of that product actually jumps up to $150? Are you forced to sell it at that $100 price you locked in and take a massive hit? No way. Remember the definition we literally just covered? It gives you the right to sell, not the obligation. If the price rises, you just walk away. You don't have to sell a thing. Your loss is strictly limited to whatever small fee you paid to get that contract in the first place, a fee we call a premium. Think of it kind of like an insurance deductible. Your risk is completely controlled from day one. All right, let's bring this powerful concept right back home to the stock market. Imagine we're looking at the Nifty 50 index. You know, that basket of the top companies? And right now, it's sitting exactly at a major psychological level, 20,000. For an absolute beginner, tracking a broad index like this is a fantastic way to understand general market movements before you ever try diving into individual stocks. So, we're going to apply the exact same logic we just used in our real-life analogy. The Nifty 50 is at 20,000. You do your homework, you run your analysis, and you expect a fall. You firmly believe the overall market is going to drop. So what do? You buy a put option. Let's say the market reacts exactly like you thought it would and the Nifty tumbles down to 19,500. Because you brilliantly secured the right to sell higher, your option becomes incredibly valuable. As the Nifty falls, your option value actually increases. You are literally making a profit while everyone else is stressing out watching their portfolios turn red. So the absolute crucial takeaway here is this very simple equation. Put option equals an expectation of downward movement. Whenever you're analyzing market trends and your brain tells you, okay, this is going down, your very next thought as an options trader should instantly be put option. It is the direct, real-world translation of your downward market expectation into a totally tradable action. But hold on, before you run off to start trading, we definitely need to put up some guardrails. Let's look at the 3 most common beginner traps. Mistake number 1, buying a put without doing proper analysis. Just because you have a feeling that the market should drop doesn't mean it actually will. You still need your charts, your trends, your logic. Mistake number 2, expecting the market to fall always. Look, put options can absolutely make you money on the way down, but historically, markets trend upward over time. Don't turn into a permanent pessimist just because you learned how a put works. And mistake number 3, not managing your risk. Yes, your loss is limited to the cost of the option premium, but if you're constantly guessing wrong and bleeding that cost over and over, it is going to drain your account. Always be smart about it. All right, let's do a super quick summary of what we've conquered today because honestly, this is a massive milestone for us. A put option is your right to sell. It's used specifically when you anticipate the market is going down. It provides a limited, perfectly controlled loss if you happen to be wrong, but generates a solid profit if the price actually falls. If you understand these 4 basic bullet points, you have officially laid the full, basic foundation of options trading. You now completely get that a call means up and a put means down. Huge congratulations on hitting that milestone. But our explainer doesn't just end here. I've got a fun little bonus challenge for you today. Open up any stock chart. Honestly, it doesn't even matter which one. Look at the trend and ask yourself one simple question. Is this going up or down? Try to predict it. If your analysis says down, well, you now know exactly what tool to reach for, right? That's right where the put option comes into play. You are officially analyzing the market. So practice this today, get really comfortable with the concept, because tomorrow in day 5, we are tackling strike prices, and trust me, it's going to be absolutely crucial. Keep following the series, keep this foundation strong, but I have to ask, are you ready to predict your first market drop? I'll see you in day 5.